Congratulations! That is an incredibly hard-earned achievement. That $1 million balance represents two distinct owners. One is you, and the other is a silent business partner you've never met, the IRS. This dynamic started in your 30s when you first enrolled in a pre-tax 401k. You checked a box that let you skip taxes on your contributions today in exchange for paying those taxes on the way out. While that account compounded for decades, the uncollected tax debt compounded right alongside it. Every dollar of gain in that account is also a gain for the government. Your monthly statement is a combined total of personal wealth and a tax liability that hasn't been priced yet, and you aren't the one who gets to set the final rate. When you turn 75, the government triggers a required minimum distribution. This is the moment the IRS begins forced collection on your pre-tax savings. A $6 million balance is divided by the mandatory 24.6 divisor, requiring a $245,000 withdrawal. That drops onto your tax return as ordinary income, like a paycheck. Meanwhile, a 6% return generates $360,000, leaving the balance larger than it started. Because the growth outpaces forced withdrawals, the mandatory distributions keep increasing year after year. The IRS is chasing a balance that is actively expanding. This tax spike is a mathematical certainty of the account's own growth. The higher your balance climbs, the more aggressively the government forces you into higher tax brackets. These rules become more punitive if one spouse outlives the other. The survivor is forced to file as a single person, which cuts their tax brackets roughly in half, while the mandatory withdrawals remain the same size. The next generation faces a different hurdle. Under the Secure Act, adult children who inherit a pre-tax account must completely empty it within 10 years. To empty a multi-million-dollar inherited account in a decade, it is divided into 10 equal parts taken as taxable income. Landing in their peak earning 50s, this stacks hundreds of thousands of extra dollars on top of their highest career salaries. Without planning, a large pre-tax inheritance functions as a mandatory tax bill that hits your family during their most expensive years. Being under 60 with a large balance provides a unique opportunity. You still have two distinct windows of time to change how this money is taxed. This timeline identifies those periods. The first is your contribution window, open as long as you draw a paycheck. You can move all new savings into a Roth bucket. You pay tax today, but that money grows tax-free forever, safe from forced withdrawals. The second window opens during your gap years, between retirement and 75. With no salary, your reportable income hits its lowest point. Use this period to move old pre-tax money into a Roth account, paying a much lower tax rate than in peak earning years. Most people only realize they have a tax problem after they retire, and the first window has already closed. Staying under 60 means both opportunities are still available to you. You can start this week by looking for a Roth deferral option in your retirement portal, or by speaking with an accountant about a backdoor Roth IRA. This formula calculates your future exposure. Take your current balance, double it for every decade remaining until age 75, and divide by 24.6. That total is your estimated annual forced withdrawal. The traditional 401k served its purpose during your early career by capturing employer matches and reducing your immediate taxes. You have simply reached the point where your balance has outgrown that specific tool. If that future withdrawal is larger than your planned retirement spending, you can use the next several years to shift your savings into a structure that gives you back control.